So welcome to this edition of Asia Gaming Brief's face-to-face series. With me today, I have Colin Mansfield, who is a gaming analyst with Fitch Ratings. He's based in Boston, but covers the Asia-Pacific region. And that's what we're going to be talking about mostly today. So welcome, Colin. Thank you very much for joining us.
Thanks for having me, Sharon. Looking forward to it.
So we are now nearing the end of the first quarter. I just wanted to get your perspective just to kick off on how events have compared with your initial outlook for the year.
So I don't think our expectations have changed too much since our outlook season, which happens usually around the end of the year. Going into 2021, we had a feeling that the first quarter and now the first half were really going to be, seeing a lot of similar stresses that we were seeing towards the end of last year, as you saw virus cases spike up. So I don't think what we've seen transpire during the first quarter and commentary we've heard from operators on their fourth quarter earnings calls has really surprised us. We knew that travel volumes and gaming volumes in international jurisdictions were going to have a tough start to this year, but we are a little bit more positive still on the second half of this year. It's nice to see some of the caseloads come down. Vaccinations are starting to roll out, so we're seeing progress. So we're still feeling better about the second half of this year than the first half, but I don't think our expectations have changed too much.
That leads me on to the next question there, because obviously they're going great guns with vaccinations in Europe and the US, seem to be a lot slower in the rollout across Asia. Is that a concern?
So full disclosure, I'm not a public health expert, so I never try to get too granular in trying to forecast things like that. But if you just think about on a high level from a geographic basis, obviously faster vaccinations is a good thing relative to slower vaccinations. That being said, I do think gaming operators that do have APAC exposure do have sufficient liquidity to sort of ride out the storm if the pace of rollouts isn't necessarily the same, because ultimately what you're trying to get to is people's travel and spending patterns resuming to some sort of normalcy. So I think, jurisdictions that have more exposure to international visitation, it's a little bit more of a concern. But again, the operators have sufficient liquidity. They've been able to ride out the storm thus far. And we do think sort of the worst days are behind us now that we are actually seeing progress on the vaccine front.
Right. So, yeah, we are like a 1 year in some cases, 80% drop in revenue for a lot of the operators across the Asia Pacific region. How much of a strain has it put on the balance sheet? And are there any areas that you're concerned about?
Yeah, so gaming operators have done pretty well through the pandemic relative to other really severely hit leisure and entertainment sectors. Capital markets have been open. They've been able to get the additional liquidity that they've needed to sort of ride out the storm. I will say the good thing is that we're not necessarily in the same type of cash burn situation, I think, that we were towards the middle of last year when, you were having properties closed for an extended period of time. The operator has done a really good job of pulling costs out of the business, reducing that cash burn. There has been some debt issuance to sort of pad balance sheets with additional liquidity, but we really are going to start seeing cash flows start to ramp up, we think, towards the end of this year and into next year, which will position them well to take care of sort of these conservative positionings that they might have taken in terms of adding additional liquidity onto the balance sheet. And I will say too, a lot of the operators in the APAC region and global gaming operators in generally have or had less balance sheet leverage going into this than their US counterparts. So they were in a little bit of a better position from a balance sheet perspective going into this to be able to ride out the shock.
Should this protract further, though, or we have an unforeseen extra wave, how much room is there for extra cost cutting, would you say, or is the low hanging fruit been done now?
A lot of the low hanging fruit is already done. Operators are running pretty lean and mean right now with, not necessarily all of the F&B offerings open. Some of the entertainment options not open as well too. But what gaming, has really benefited from in a lot of jurisdictions is that right now it's really the only option in town if you really want some sort of entertainment value. So they've done a really good job of pulling the costs out of the business, reducing that cash burn, specifically in periods when, the properties were closed, and we're not in that situation anymore. But I would say, operators have done a really good job of doing everything that they can to pull costs out of the business. I'm not sure there's too much meaningful room to go. They probably would have already done everything that they could have because the middle of last year when the properties were closed, that's sort of the worst case scenario you can think of.
Do you have any particular concerns, either in terms of geographies or particular companies, when it comes to balance sheet strength at the moment?
None that I would specifically call out, but broadly speaking, I think, the jurisdictions that we have a little bit more concern on are ones that are more reliant on international visitation. And those are the companies that we're building in longer recovery assumptions into our forecast. So you think of places like Singapore, Macau, Las Vegas here in the US. Places that really rely on inbound visitation are going to have longer recovery trajectories. Now, that being said, Macau does rely a lot on inbound visitation. Thankfully, a lot of it does come from nearby Guangdong province. But we do still think Macau is going to have a little bit of a longer recovery trajectory than other markets that might rely more on local visitation, drive-to visitation. There, especially here in the US, we've seen that come back a lot quicker because you don't need to get on an airplane or you're not dealing with any sort of cross-border restrictions, things like that. So I guess the one, if I had to point out a concern, it would be jurisdictions that rely on international visitation are going to see a longer road back.
Okay. And what about the ones who do have the stronger balance sheets right now? Is this an opportunity for consolidation in the industry? And do we need consolidation, or what's your view on that?
It's surprising there really wasn't too much material pandemic-driven M&A. I just don't think I don't think the pandemic in and of itself created enough opportunities for, companies with really strong balance sheets and lots of liquidity to go out and consolidate or purchase assets that, they had been looking at for a long time. For the most part, capital markets access has been open for gaming operators, so they've been able to get the liquidity to ride out the storm, and valuations have pretty much held in there. So I just don't think a lot of the opportunities that one might would have expected, presented themselves from the stress that we had last year.
It's an interesting point. One who does have cash on the balance sheet and is looking for somewhere to deploy it, of course, Las Vegas Sands. You recently said that you felt that the sale of the assets was slightly credit negative. What would it take to turn that around?
So I don't know if we're looking for something explicit to happen to turn around that viewpoint. Again, having the extra liquidity on the balance sheet right now is never a bad thing. We are losing a little bit of diversification, and it isn't exactly clear right now what the ultimate use of proceeds will be. I know they presented a few different options, but there is still some uncertainty around that. But one thing I do want to point out at the end of the day, Las Vegas Sands is a strong credit with a long history of prudent financial policy management. We kept their investment grade credit rating through the pandemic and through this asset sale. So we do still think the long-term story is intact, notwithstanding the pandemic and this asset sale. The projects that they have going on in Singapore and Macau, those will increase the value of those respective subsidiaries. So we do still feel confident in the long-term story about Las Vegas Sands. It is a strong credit, but on the margin, this transaction in and of itself we thought was slightly negative.
Okay. And if there was something you would like to see operators across Asia doing now to shore up their balance sheets or to improve their credit rating from the way you look at things from a credit analysis point of view, what would that be?
Yeah, so as we're starting to hopefully exit this pandemic in the next couple of years, a couple things that we're focusing on are one, how sustainable are the margin improvements that we've seen across the industry? Again, and like we talked about, some of the amenities aren't open right now. You're really only offering gaming in some places and not all the other non-gaming elements that customers are kind of accustomed to. So as you start to see spending patterns and travel patterns resume some sort of normalcy, and you have other, sort of entertainment options competing for gamblers' wallet share, we want to be able to hopefully see how sustainable some of these margin improvements really are. And then on the flip side of that, once you start to see cash flows start to improve, which we think, towards the end of this year, beginning into next year, we really want to start to see, some of these pandemic-driven debt raises start to get paid down. A lot of operators are sitting on excess cash right now, still just as sort of rainy day buffer. But when the recovery trajectory starts to get a little bit more firmer and we get a little bit more clarity, we'd like to see some of the debt that was raised during the pandemic start to be paid down.
Okay. I would like to just ask a question on Macau, if I could, about
Sure.
the the concession renewals. Does that play into your risk analysis at all? How do you view that at Fitch?
Yeah, of course. I mean, that's sort of, your stereotypical, event risk, tail risk, when you're thinking about a credit, like any of the Macau operators, because obviously a loss of their concession would be, extremely detrimental to the credit profiles there. That being said, we've always had the viewpoint that we think the government is going to take a pragmatic approach to the concession, renewals or rebids, however you want to phrase it. All of the operators there are good corporate citizens. They all scored well in the midterm reviews. They've invested a lot of capital. They also employ, a good amount of the local population. So we do think the operators have been doing everything, that they can to show that they're good stewards of capital, and that they deserve to remain to operate in Macau. So we do think the government's going to take a pragmatic approach. There's a lot of different ways that could take shape. It's anybody's guess right now. The tax rate there is already one of the highest in the regions. There's not a lot of developable land left for a large number of new operators to be able to come in. But some things that we're thinking that could happen is, again, you could get a seventh concessionaire. You could have more longer term commitments for development, especially in the non-gaming area, one-time license fees, things like that, which all those sorts of things are sort of on the table, in our opinion, but it's anybody's guess at this point, and we're looking for clarity from that region hopefully later this year.
Sure. And one last question, if I can, on VIPs, obviously is the other big talking point at the moment, the VIP market in Asia. How do you see that coming back, and how are China's policies against capital outflows going to impact that?
Yeah, so the VIP segment, we think, is definitely going to be more challenged, in terms of recovery trajectory than your mass or premium mass, especially as it relates to Macau. I think broadly speaking, if we're thinking about the Asia Pacific region as a whole, we've always been a little bit more downbeat on VIP, just because you've had an extreme amount of competition from other jurisdictions opening up, trying to lure those VIP players, away from Macau. But what Macau has always had going for it is the fact that you have this beautiful critical mass of integrated resorts that really you can't really compete on quality. Same can be said about Singapore, some of these really strong jurisdictions that have been around for a long time and compete very well for the VIP. We do think that some of the developments out of China, again, add to that sort of uncertainty around when does VIP fully recover to where it was, on a pre-pandemic level. And remember, 2019 was a pretty tough year from a VIP standpoint to begin with. So we really look more highly upon operators that are going to be focusing more on premium mass and the mass business. A lot of the development that you see in Macau right now is really geared towards the premium mass, and you're even seeing and hearing from operators that are taking existing product they have and trying to convert that more into a premium mass style product. So we do feel stronger about those type of operators and what their recovery trajectory looks like, because VIP it's inherently volatile, and it's extremely difficult to predict. So the way we're thinking about at least our assumptions is that's going to be a longer road of recovery, with a lot more uncertainty.
Thank you. So anything else you'd like to add that we perhaps haven't touched on, or?
No, I think we covered everything. I really appreciate taking the time today, Sharon.
No problem. Well, thank you very much for joining me. That was Colin Mansfield, and he is an analyst, a gaming analyst with Fitch Ratings. Thank you, Colin.
Thanks, Sharon.